Hey guys, it's Max. How's everyone doing today? I have Jax and Aspen. Behind me, you can see Aspen, the big white dog. I don't know if you can see Jax, but you can probably see Aspen. All right. I found a really cool ETF that I thought you guys might like. So let me share the screen. Let's talk about this for just a second. And I even put it in my retirement simulator. We'll see how it would have done. It's not a new ETF. It's new to me. I've just noticed it recently. Okay. And I am going to compare this to some old favorites for sure. I hope you guys like this one. I thought it was pretty cool. It's called XVOL by Accruance Capital out of Dallas. If y'all ever heard of this, it's a title ETF, which means it's one of Mike and the crew's over their title. It doesn't have anything to do with Jay. It's managed by the people over out of Accruance. I bet you, I get the idea by looking at the website. This is kind of, this might be Accruance Capital's trademark strategy or whatever, kind of like Hedge, the same way Hedge is for Jay. But these guys appear to be wealth managers out of Dallas. They're located right at Preston Road in Dallas. And, you know, there's a lot of wealth to manage in that part of the world for sure. Okay, so this is a darn interesting ETF. The other night in the Retire on Dividends live stream with Jay, well, I guess it was Sylvia too, people in the comments were begging for a VIX ETF, me included. But, and this really isn't that, but this is an ETF that's really interesting that does use VIX to hedge. I think the people in the comments were wanting something like SVOL or ZIVB for Jay to come out with something like that. This is more like Hedge. This is an all-weather ETF that, in theory, you should be able to buy, and it should be able to ride through all different market, types of market. And, I'm going off of the promotional materials. That could be a little dangerous, but they do have some really interesting ideas, and they've had a pretty good record so far, too. So I definitely thought it was something I wanted to show you guys. Okay. So these guys, they also use AI in here, but when their AI anticipates bearish, times ahead, they aggressively hedge with fixed calls. I'll show you their slide deck in a second. We'll look at their presentation. So the dividend, I pulled up the past year's performance, and this has only paid a 20-cent dividend over the past year. That's one thing that worries me a little bit. However, in the past year, we've been in a straight, pretty much bull ripping, face ripper bull market. So maybe the AI doesn't sell options when the market's going up. And that's not the worst idea. As long as they can sell extra options when the market's going down. The market hasn't gone down for any sustained amount of time lately. So I would like to talk to them about why it has such a low dividend so far, because in their marketing material, they act like the dividend's going to be a big part of it. But then they've been out about a year, and so far they haven't really paid much of a dividend. Okay. Now here's the thing about these. A lot of people say these funds are just repackaging your own money and giving it back to you, and you have to pay taxes on it. And, that is true. Some of that's true. In a taxable account, that's absolutely true. So that's why if we don't need the income, we don't mess with these types of funds. Okay. Well, but you can, if you like options and you like option hedging and you believe in trading volatility and you understand how it works and stuff, you can use one of these funds like Hedge or like this one that really don't pay much of a dividend, but they aggressively hedge the downside. You could also look at TJUL, TJUL, and I've done a video on that. That hedges out 100% of the downside over a 2-year period. So they're doing some really innovative things with being able to hedge out the downside lately. This is Accruance Capital's attempt to hedge out the downside. So let me show you their, here's their website. It looks like XVOL is their only ETF that I could find. I looked at the prospectus, and they do some interesting option stuff, but this isn't going to be an in-depth report, so I'm not going to put you guys through that. But let's read the fund summary, maybe the second paragraph. Accruents invest in companies that pay dividends and companies we believe are positioned for growth. The portfolio is rebalanced to represent what we believe is a strategic blend. Additionally, we seek to reduce volatility by purchasing call option contracts on the VIX. I love this part. Accruents uses a proprietary volatility-based algorithm to determine the number of VIX option contracts to purchase, as well as the strike price and expiration date. So maybe the AI gives them the percentage of overwrite. Maybe they can overwrite the whole portfolio, or these aren't really overwrites. This is more like insuring the whole portfolio. But anyway, so it varies the number of contracts, and it varies how far it is out of the money. Well, so I'd be interested to see how it does, though. And so we're going to find out here in a second. We're going to look at, they have a kind of a limited history. They've been around since April of 2021. Okay. Their assets are $7 million. I get the idea that even though that's not a lot of assets, I get the idea it's this company's trademark strategy. So I think the break even on this fund is probably whatever these guys want it to be, because it's their own company. They probably I'm guessing these wealth managers put their own clients in this same strategy and probably have for years. And the strategy probably has a longer track record. They probably made an ETF version of the strategy, and that's what this is. That's kind of all the rage nowadays. And that's what Mike Venuto and I were talking about with these white label ETF providers. Mike is right in the perfect place to take advantage of this trend in the ETF business, taking family offices and taking wealth managers' private trading strategies and turning them into an ETF. So then that way we can all invest in it. And I don't think that's the idea, but the idea is probably so the wealth manager can get more fees. I get that part of it, but it's a great time to be a consumer, right? Okay, so speaking of fees, I haven't even mentioned the expense ratio. There it is, 83 bips. Okay, been around since April, 7 million under management. It trades at $21. Shares outstanding. Who cares? Closing price. Let me show you some other stuff about this. Here is since inception. Since inception, this fund's up 12%, but the S&P's up 42%. Okay, so now let's look at some other stuff here real quick. Like I said, I'm not going to get too involved in what's going on. Not going to get too involved with the options. I think this is their slide deck or their PowerPoint, whatever you want to call it, I guess. Okay, but I am really interested in this stuff, and it talks a little about their AI. So let's kind of go through it together. I'm going to maybe make it a little bit bigger so I can read it. Tail risk hedging with options on the VIX involves strategies aimed at protecting against extreme market downturn or events. Hedging mechanism by purchasing VIX call options or employing other VIX-related strategies, investors aim to profit from increased volatility during market downturns. This can offset losses in the overall portfolio, and we talk about volatility all the time on this station. I'm obsessed with volatility. So this is a VIX tail risk hedging strategy. Oh, this is limitations or challenges. So these are disclosures, timing, time varying correlations. The effectiveness of a VIX hedging can be affected by time varying correlations and co-movements between VIX and the stock market. I call that path dependencies. And I think that's another word for it. Predictive power. While the CBOE volatility index, VIVIX, and as you guys know, I talk about that all the time, and that's kind of the central thing in my volatility trend following system. Anyway, VIVIX is the shit, and they use it in here. They use it in their system. They do mention, though, in the disclosures, the VIVIX doesn't always tell the true story. And these VIX options they buy have a low likelihood of profit. And that's kind of what they're kind of like doomsday options. This isn't an income strategy. This is more like a doomsday strategy. But they do that at the same time they stay invested in the market. So the idea is you can invest in it and still sleep at night. All right. So I don't understand this active share. I would like to get this manager on here. AI model. This is really interesting. So this phase detection engine is what they call their AI proprietary regime identification framework. So this says what phase the market's in. Given that, they know what to do. They know how many VIX calls to buy or not to buy. They know what to do with their underlines. Okay, so what they do is they have approximately 50 stocks. They write puts to get the stocks. It's kind of like you do on the will, but then they also write covered calls. I mean, you could kind of call this a will because they do a lot of the will things. They write puts to obtain the shares. They write calls sometimes depending on what the AI says. Right here, it's the disclosure on the calls, and it says limited upside potential. So I guess they don't know about call spreads yet. Maybe they need to check in with, maybe they need to call Jay. I'm just joking. These guys obviously know about freaking call spreads. I'm sure they do them too. All right. But anyway, I'm real interested in this. So this probability volatility model, you guys know I'm always talking about my volatility model. I'm trying to model the same thing they are. They're more sophisticated, undoubtedly, but we're both trying to look at volatility and see if it can inform a tactical decision on the S&P, on the broader market. It says it is the fund's intent to sell options periodically, weekly, and or monthly for the purpose of harvesting option premia subject to market condition and the availability of options and subject to the availability of the option markets. There's no guarantee that this objective can be met. Well, so one thing I looked at, and I always check, I just checked how it's done over the past year, the same time that JEPI's been around. I compared it to JEPY since September 19th. But because I was wanting to look at something. So look at it. It just says XVOL paid a 20-cent dividend, and that's over the course of a year. So that's the part I don't know about. Now, they've made a 19% total return, which is quite a bit better than the covered call funds I like and everything. So they're doing really well. Let's compare XVOL to SPY, and I'm sure it's going to be way behind SPY. Yeah, SPY's up 29%, XVOL's up 19%. But the thing is, XVOL is fully hedged at all times. And if the market drops, XVOL really shouldn't drop that much. That's the idea. That's what you're paying those 83 basis points for. Okay, so let's keep looking at this. Let's keep looking at this slide deck. There's some other interesting stuff I saw in here that I thought you guys might like. So here's some of their top holdings in their dividend stocks. Look at this. Verizon, Brookfield, that's a REIT. These are income producing stocks, and they have 3-4%. But then they have some growth stocks, Best Buy, and some banks. There's Truist Financial Corporation. But anyway, it's really interesting. So they don't just blindly buy the index. They choose 50 stocks, and they choose stocks that have high dividends. And in addition to that, they sell calls on those stocks. So I'm really liking this now. So let's see what else we can find, or let's go through this. So this is their tail risk hedging. I mean, this is the idea what they're supposed to do. They're supposed to run a tail risk hedge. That's buying those VIX calls out of the money to prevent black swan. Then at the same time, income enhancement, at the same time, writing options weekly. And then maybe they've been writing the options and just not paying the dividend. Maybe they've been retaining the earnings. And I didn't think about that. And maybe they're using the option earnings to pay for their hedges. And if that's the case, that's cool. That's probably what it is. I really need to get this guy on here. I think his name's Rich. He's an interesting looking dude. Has an interesting background. But okay, so then they're going to own large cap stocks. We saw those, like the ones we just saw, the banks and credit card companies and whatever. All right. So 50 holdings, that's their SEC yield. Okay. Now this I really like, and I'm not going to get too deep in the option stuff, but when I first saw Jay, the first question I asked him, I said, Jay, you've got to do a fund. Instead of selling a naked put, sell a put spread. You cut off the unlimited downside. Anyway, and he said he thought about it. He's whatever, and he still hasn't done it. But he did introduce SPY T, which has the same effect. Anyway, because he sold a call spread. It has the same effect. Well, anyway, these guys are actually doing the put spread. They're selling puts for income, but then they buy a put behind it so you don't have that unlimited downside whenever a stock drops 10% due to an earnings announcement or something. That's what ULTY is going to start doing also oftentimes. Okay. So this is very interesting. Of course, we all know about covered call writing. The idea is that you stay fully invested all the time, but you're mitigating this, the most severe outcomes. So in bull markets, you're generally accompanied by, bull markets is low volatility. So this means the call options on the VIX are likely to expire worthless, or they will expire worthless in a bull market. You're pissing money away, basically, but you're strategically doing it. Okay, in a bear market, call options on the VIX may or may not expire in the money. It depends on how fast the bear market goes down. Generally, VIX call options profit from really fast-moving, explosive markets, black swan type events. That's what the VIX is really good at hedging against. Okay, or what also called a crisis bear market. Yes. Then in that case, your VIX call options will turn into a profit for you. But of course, your stocks won't be doing well during that time frame. So that's why they call it tail risk. It's the tail of the distribution curve is what they're talking about. Of course, most of the curve happens in the hump of the curve or whatever, but right out there on the tail, see, when you have extreme down days and extreme up days, there's days the market's been up 3% or something crazy. That's a tail risk on the bullish side. But in any event, so crisis bear markets would definitely, the VIX would kick in. So profits from the VIX index call options are used to offset the losses from the crisis bear market. Okay, so this would have worked like in the COVID situation. This fund was not around. They started it shortly thereafter, and I bet you they back tested it on COVID, and I bet you it works really well. I guarantee you it does, because these guys sat there and watched COVID, and I mean, we'll see. I just need to have these guys on. All right, so here's your contact information. Yeah, like I said, it does not get any better as far as addresses go. If you have a Preston Road address in North Dallas, yeah, there's a lot of assets to manage up there. Accruance Capital. And I love the name Accruance Capital, by the way. Okay, so what else? Yeah, I'm sorry, his name's not Rich. It's Rob Emrich. He's the managing partner, and I bet this is his baby. All right, so he's done some other stuff on the internet, and I may watch some of that stuff and react to that, but that's a separate video. Let's keep on topic here. Now let's compare this XFAL to some of the old-time favorites here. All right, let's see. Now, so I wanted to get out funds that have been around for at least a year. I don't know if FEPI had, well, close enough on FEPI. But Hedge, certainly. SFAL. We all love SFAL, don't we? And then XFAL. Now, they have similar names, but they're totally different funds. But even though they're different funds, they're gonna have similar profit loss. So I guess they are basically similar funds. They have a totally different way of solving the problem, though. XFAL and SFAL. All right. So, and then we have WDTE, which is what Jeppy's called nowadays. I put it on here as kind of a benchmark for everything. I don't know why people ever even show this chart, this price return. On dividend stocks, price rate that doesn't even matter. Because they pay so much of the return comes from the dividend, the price return really doesn't tell you that much. Anyway, all right. Total return. So look, the one that was at the bottom on price return, which was JEPI, the one I like, WDTE, the Defiance one, is on the top, just murdering it the whole time, the entire time. JEPI's a lot better than people give it credit for, or WDTE. Now, lately, it's pulled back and it's in second place to XFAL. XFAL from Accruance Capital passed it. You can see back here in March of 2024, XFAL kind of broke out of the pack of the other funds and started doing really well. Now, I want you guys to notice this. Remember that August pullback? Look at XFAL. That's their VIX hedge working. It was up for 34% for a day. That came back the next day, but they probably had a VIX call that went in the money for a day or two. But in any event, that saved them from a loss. Yes, the market ended up turning around and rallying, but had the market crashed, that, you know, this is the position they were in. I love that because they can stay fully invested all the time. Presumably, Z-Hedge is in the same position. Z-Hedge has on hedges pretty much all the time, and so does T-Jewel. Oh, I don't have T-Jewel on here. Let's add T-Jewel. TJUL is a similar type of fund. It's innovator equity defined protection, but they hedge themselves with options, just like all these other funds. So it's a fair comparison. I just hate how it defaults to price return. Should default to total return. All right, total return. So now T-Jewel's up 12%. It's actually the worst. It's actually the worst performing of all of them. I just highlighted it. Now, it is guaranteed not to lose any money. They buy in at the money put. Well, buying protection's expensive. The problem is, in a bull market, your expensive protection costs you return, and you're the worst performing of the bullish funds. So in any event, okay, so that's T-Jewel. Now here's JEPY, which is WDTE. I mean, 20%, that's total return. That's pretty good. Here's XFAL, 25% total return. That's even better. Boy, that XFAL is really impressive. Now here's SFAL. SFAL kind of underneath WDTE, but above TJUL. Here's, look at Z-Hedge doing really well, 22%. That's good from Zega Financial. And there's, of course, FEPI's a favorite. It's up there close to the top. Okay, we have some other stats to look at right here. I wanted to show this. Here's the dividend yield. You can see Z-Hedge and XFAL, they don't really pay a dividend, but I think they recycle the yield they do make into hedges, and so I'm cool with that. But now FEPI and SFAL just pay all the money they earned, and for God's sake, JEPY just pay everything out. T-Jewel, I don't think it has a dividend. In any event, let's look here. All right, let's see. Let me show you what else I wanted to show you. No, not that. Not that. Aspen, what are you doing? But anyway, I really like this AI model. So their AI model told them to hedge, evidently, in August, and they did because they had a huge profit there. So, incidentally, my volatility model said to hedge also, and I told all of you guys to hedge. Some of you guys did too, and that August was vicious. Okay, well, that looks like that's about all I got for right now. It looks like we've covered everything we need to cover on this fund, but I'm going to start keeping an eye on it. One other thing we're going to do, though, I put it in the retirement simulator. So you guys know kind of my model portfolio is 60-20, 60-20-20, where you have SPY and then you have bonds or some type of surrogate for bonds. It could be, there's lots of them. But then with the last 20%, you can get some of these higher yield funds. You sprinkle it in and you could get a decent return. This allocation right here is about $3,000 a month after a 50% tax. That's if you're in the highest tax bracket. You still make $3,000 a month with this allocation. Okay. So that's not, not terrible. But now what I wanted to see is we could substitute instead of SPY. If we wanted less risk, if we were afraid the market was going to crash, we could get an ETF like Z-Hedge, T-Jewel, or XFAL. So right now I want to simulate if we would have got XFall last September. Okay, so we'll just do that portfolio and see what they would have made. Unfortunately, the NAV return's only up 9%. This didn't have as much NAV return as the other portfolio, and it had a little bit less income, but it had a heck of a lot more safety. We just can't see it over the past year because the market's gone straight up. So the only thing we can see is dampened returns. But in any event, I'm going to leave it in the simulator. And anytime we look at a new stock, I'll put it in the simulator until we pretty much have everything in the simulator. But in any event, I thought you guys might be interested in it. But XFall is a solution, as is Z-Hedge, as is T-Jewel, that a conservative investor can use to stay invested, get a little bit of a premium through dividends, through the covered calls, what few they do right, and like I say, and have downside protection, which is the important thing to me. All right, guys, the dogs were very good to not totally lose it, so I'm going to get out of here before they do. You guys have a great day, and leave me a comment if I missed anything, or tell me what you think, or tell me how you hedge, or tell me what you're doing today. Tell me something. Take care.